Resembling mutual funds in their operation, ETFs take it a step further by being tradable on a stock exchange. This means you can buy or sell ETFs just like you would any other stock. ETFs are versatile, capable of tracking a variety of assets. These can range from indexes, sectors, commodities, to even investment strategies. Take, for example, the first ever ETF, the Spider S&P 500 ETF, fondly known as SPY. This ETF tracks the performance of the S&P 500 index, giving investors a piece of the top 500 U.S. companies. ETFs are traded on exchanges throughout the day, making them more liquid and cost-effective compared to mutual funds. This flexibility is just one of the many reasons why ETFs could be a valuable addition to your investment portfolio. So, why should you consider ETFs in your investment strategy? Well, one of the main perks of exchange-traded funds, or ETFs, is their ability to offer diversification. You know the old saying, don't put all your eggs in one basket. Well, ETFs embody this wisdom by holding multiple underlying assets. This means that rather than investing in a single company or commodity, you're spreading your investment across a variety of assets. This could include anything from stocks to bonds, currencies, or commodities. It's like having a mini portfolio all wrapped up in one neat package. And the beauty of this is that it can significantly reduce the risk of your investment. Now, another benefit of ETFs is that they can be either passive or actively managed. Let's break that down a bit. Passive ETFs aim to replicate the performance of a specific index. So, if you have a passive ETF that tracks the S&P 500 index, for example, the goal is for your ETF to perform in line with that index. It's a bit like having a mirror image of the market's performance. On the other hand, actively managed ETFs are handled by portfolio managers who make decisions about how to allocate assets within the fund. They're constantly monitoring the market and making adjustments in an attempt to outperform the market. This could potentially lead to higher returns, but it also comes with more risk and usually higher fees. So, whether you're a hands-off investor who likes the idea of a set-it-and-forget-it strategy with a passive ETF, or you prefer the potential for higher returns and don't mind a bit of risk with an actively managed ETF, there's an option that fits your style. And let's not forget about the liquidity of ETFs. Since they're traded on stock exchanges, you can buy and sell ETFs throughout the day, just like individual stocks. This gives you more control over when and at what price you decide to enter or exit your investment. In short, ETFs are flexible, diverse, and accessible investment tools that allow you to spread risk, choose your level of management, and maintain control over your investment strategy. There are different types of ETFs available, catering to a wide range of investment strategies. Among the variety of ETFs available, tech ETFs hold a special place, but what exactly are tech ETFs? Tech ETFs, or technology exchange-traded funds, are investment securities that focus on the stocks of companies within the technology sector. These can include companies involved in everything from software development to semiconductor manufacturing, and from cloud computing to cybersecurity. Just like other ETFs, tech ETFs offer an opportunity to invest in a broad spectrum of technology companies, which can provide a level of diversification within this specific sector. This means that instead of buying individual stocks, investors can buy shares in a tech ETF and gain exposure to a wide range of tech stocks in one fell swoop. Now, why might someone be interested in investing in the technology sector? Well, this sector has seen rapid growth and innovation over the past few decades. From the rise of the internet to the advent of artificial intelligence, technology is constantly evolving and expanding. This dynamism can make it a lucrative sector for investment. Of course, as with any investment, there are risks. The technology sector can be volatile, with stocks rising and falling in response to product launches, earnings reports, and other news events. But for those who are willing to embrace this volatility, tech ETFs can offer a way to participate in the growth of the technology sector without having to pick individual stocks. There are many tech ETFs to choose from, each with its own focus and strategy. Some popular options include the Technology Select Sector Spider Fund, which tracks the technology sector of the S&P 500, and the Vanguard Information Technology ETF, which focuses on stocks within the IT industry. There are also tech ETFs that focus on specific niches within the technology sector, such as cybersecurity or artificial intelligence. Investing in tech ETFs can provide exposure to the technology sector without the need to pick individual stocks. So whether you're a seasoned investor or just getting started, tech ETFs offer a way to tap into the potential of the technology sector. Now that you understand what tech ETFs are, how do you go about building a diversified portfolio with them? Let's dive right into it. The first step in building a diversified portfolio with tech ETFs is understanding the concept of diversification itself. It's an investment strategy that aims to spread risk across various assets or asset types to potentially improve returns and minimize the impact of a poor-performing investment. In a nutshell, you're not putting all your eggs in one basket. So, how do tech ETFs come into play here? Well, these funds track an index or a basket of technology stocks, allowing investors to gain broad exposure to the tech sector. This means you're investing in a collection of tech stocks, not just one or two. This type of diversification can help mitigate the risk associated with investing in individual stocks. Now on to the next step, choosing the right tech ETFs. There are several factors to consider. One of these is the expense ratio. This is the cost to manage and operate the ETF, expressed as a percentage of the fund's total assets. Lower expense ratios can mean more of your money stays invested, potentially leading to higher returns over time. Another factor to consider is the fund size. Larger funds tend to be more stable and have lower expense ratios, but smaller funds can offer the potential for higher growth. It's also important to consider liquidity, which refers to how easy it is to buy or sell shares of the ETF. Higher liquidity means you can quickly and easily convert your investment into cash. Once you've chosen your tech ETFs, the next step is to decide how much of your portfolio you want to allocate to these investments. This will depend on your risk tolerance, investment goals, and time horizon. A financial advisor or robo-advisor can help guide this decision. It's also crucial to regularly review and rebalance your portfolio. This involves adjusting your holdings to maintain your desired level of risk and return. For instance, if your tech ETFs have performed well and now make up a larger portion of your portfolio than intended, you may need to sell some shares and invest in other areas to maintain balance. Lastly, remember that while building a diversified portfolio with tech ETFs can provide exposure to the tech sector's potential growth, it doesn't eliminate risk entirely. It's important to do your own research and consider seeking advice from a financial professional. With the right strategy and understanding, building a diversified portfolio with tech ETFs can be a rewarding experience. So take your time, do your homework, and make informed decisions. Remember, investing is a marathon, not a sprint. Investing in tech ETFs doesn't have to be intimidating. Indeed, with the right amount of knowledge and understanding, it can be a rewarding journey. Let's recap on the key points we've covered in this video. We started by introducing ETFs or exchange-traded funds. Much like a mutual fund, these investment securities can be bought and sold on a stock exchange, offering a fluid and cost-effective way to invest. But what makes ETFs especially appealing is their ability to track a wide range of assets, from indexes and sectors to commodities and investment strategies. We then moved on to the benefits of ETFs. They provide a level of diversification by holding multiple underlying assets, reducing the risk associated with investing in single stocks. Whether you choose a passive ETF that replicates the performance of an index or an actively managed ETF, the choice is yours based on your investment goals and risk tolerance. Our focus then shifted to tech ETFs specifically. These ETFs give investors the opportunity to gain exposure to the tech sector, one of the fastest-growing sectors in today's economy. Tech ETFs can include companies from various tech-related industries, such as software, hardware, artificial intelligence, and more. Finally, we discussed how tech ETFs can play a pivotal role in building a diversified portfolio. They allow you to invest in a broad array of tech companies with a single purchase, reducing the risk and effort of handpicking individual stocks. Remember, as with any investment, it's vital to do your research and understand what you're investing in. Tech ETFs offer a fantastic way to tap into the tech sector's potential, but they also come with their own set of risks and considerations. So, take the time to understand these and consider seeking professional advice if needed. Now, it's over to you. Start your journey, delve into the world of tech ETFs, and begin building your diversified portfolio. If you found this video useful, please like it, subscribe to our channel, and turn on notifications to stay updated with our latest content.